Hello and welcome to TiElogues Q&A. And today is a funding special. To tell our viewers, TiElogue Q&A is where we invite queries from our members and get an expert in the house to answer them from you. And today the expert in the house is Ojasvi Babbar. Welcome, Ojasvi, and I'll dive straight into the questions. The first question is a three-part question sent by our member. Is CCPS and Safe Note good for early stage startups? How much dilution is considered good for an early age stage startup? And how to negotiate on valuation at seed or pre-seed stage?
Quite a broad question as such, but I'll take it one by one. So your first question was whether the CCPS or safe notes are good for early stage startups or not.
Yeah.
So essentially, I think the startups need to understand what is the underlying thesis of offering CCPS or safe notes. From an investor's perspective, CCPS, that's compulsorily convertible preference shares, are more like equity shares, but they have a liquidation preference. So in case an investor is investing in a startup and the startup goes through liquidation or any of the other processes, CCPS guys have the first preference in terms of liquidation to receive those proceeds. So from an investor's perspective, they prefer to have CCPS so that in case of any inevitable liquidation event, they get that preference. At times, investors also do tend to take one equity share so that they can have an equity voting right as well. But how it favors the startups is that CCPS shares per se generally do not have equity voting rights. So in a way, that gives the promoters or startups the entire control over equity, over the voting rights as such. So generally, when the investors invest, they try or they tend to keep a large chunk of CCPS and probably one equity share so that they have a little bit of voting say therein as well. So it's quite a balanced proposition. And in terms, since these are preference shares which are later converted into equity in any of the other funding rounds, that gives a little bit of leeway to the startup as well. As against the safe notes, they are primarily oriented to let the startup focus on their business more and less of compliance, which generally comes in with equity shares or any of the preference shares, because safe notes are simple agreements for future equity. So whenever you're doing an equity round or a dilution round, the equity gets converted as per the safe note at a later part. So meanwhile, during that particular period, the startup can completely focus on their core competence or their core work and not worry about the MCA compliance or any of the other compliance, which is with equity or preference shares, which is involved with these two elements. So my personal suggestion to startups is that in case they are going in for a very early round, let's say a seed stage round or a very early pre-series A as such, if they have an option to do a safe note, which generally the investors are comfortable with, they should ideally go with that. If not, CCPS is an equally good option.
Okay. The second part of the question, how much dilution is considered good for an early stage startup?
Right. So that again is a very subjective question as such. For the simple reason, typically when the investors invest, they look at what kind of exit would they get in further rounds. So let's say if a startup dilutes 15%, 20%, or let's say more than 26%, it becomes difficult for the further investors to come in and take that significant equity, wherein the interest of the promoters stays intact. So generally, the ballpark is that if you are diluting between 5 to 15% at a reasonable valuation, it is good enough. But anything beyond that, and if anything goes beyond 26%, wherein the resolution blocking authority comes in, that puts the startup in a difficult stance. So unless and until the startup is planning to raise a single round and then get into a stage wherein they would generally raise an institutional round, which is pre-series A or pre-series B equivalent, the suggestion is to keep equity in 10 to 15% bracket plus minus 5%.
Okay. The third part is again a very generic part, but I think this is where the founders need help. It's a start point that how to negotiate on valuation at seed or pre-seed stage. So any tips that you can give them?
Right. Again, I can talk more from an investor perspective here. Generally, what the investors do is they value your company with regards to the growth that you're currently having. So the price earnings growth, or the traction growth at which you're growing, they just assume or extrapolate at what level you would be after, let's say, 12 months or 18 months of runway, and then extrapolate that. Let's say if you raise around, then what would be the valuation, and then back calculate that whatever valuation the startup has proposed, does it fall in the good figure of acceptance or not. But from a startup's perspective, they should ideally look at three key things. One, are they growing at a decent rate? If they're growing at a decent rate, they can always ask for a valuation comparable to their peers, or a little better than their peers if the growth is high, or if their CAC is low, the cost of acquiring a customer is significantly low. Then the second one is, let's say if somebody to replicate their entire model, and how much time would it take, or if there is a significant barrier to entry, would they be able to prevent any of the competition from moving into that particular business at that particular stage or not? If the answer to these questions is yes, there is a strong barrier to entry and the cost of replication is high, or if they are in a B2B business and their displacement cost of somebody else replacing them is quite significantly high, they can demand a higher multiple to their revenues, or to any of the other multiples which are generally in play during that particular stage. So, for example, let's say if it's a B2B edtech company, they can possibly look at a revenue multiple. If, let's say, that's a pre-revenue company, they can possibly look at a multiple of CAC if it is going significantly down as such. What could be a CAC cost in a different scenario altogether as such? So to negotiate, they would have to keep the numbers at the back of their hand, be
Okay.
confident that nobody else can replicate that, and possibly move around these figures of valuation multiples. Though investors do use different modes like DCF, discounted cash flow, or current cost of capital discounted significantly over the risk premium as such, different models as such, but the prevalent ones are a multiple of revenues, multiple of bottom line, cost of acquisition of a customer and their multiple, or the cost of replication.
Okay. Moving on to the next question, Ojasvi. Which method to choose for valuation of an early stage startup? And what are the formalities when you're raising funds from friends and families living abroad?
Right. From an investor's perspective, generally the valuation of an early stage startup is typically done basis the comparables. And when we say comparables, let's say it's a B2B SaaS company or a B2B edtech company, and a similar company in, let's say, in a similar scenario has demanded a multiple of, let's say, 20x of revenues or 30x of revenues, and the traction or growth multiples are similar, the investors generally tend to keep a similar spot for valuation. As against, let's say, if it is one of the ventures wherein there is the team is quite committed and there's the team's expertise which can only pull off that kind of venture. For example, there have been a lot of aerospace ventures which have been coming in from IIT Chennai or any of the other ones. That's wherein the human cost of capital and the premium to the expertise comes in. There's a larger barrier to entry, the advisors are large. So that's wherein the investors tend to give them a higher multiple or a higher premium in terms of the capital as such. But in terms of valuation, different investors have different approaches and different preferences. Generally, if the investor is Series A or beyond, they would like to do valuations based on discounted cash flows or projections. If it is an early stage or a pre-seed investor, the valuations are quite subjective, and comparables or cost of acquisition or any of the cost of replication multiples are generally taken in. Now,
Okay.
I think the second question of
Yeah.
yours was
The second question was, what are the formalities in raising funds from, friends and families living abroad?
Right. So generally, there are no technical, formal difficulties as such. But in terms of technicalities, I hope you know that RBI has the liberalized remittance scheme. The earlier the limit was about 250K, $250,000 in a financial year. So let's say if you're, if any startup is raising funds from friends and family who's living abroad, they would have to make sure that from a single entity. Actually, this is from India, for an investor investing from India to abroad. My apologies. Let's say if somebody is investing from outside into an Indian entity, they would have to look at parking the funds in an escrow account in case. And those funds cannot be utilized unless and until the transaction is complete. Filing in for FCGPR or FCTRS in case of this an external entity purchasing shares from an Indian entity as such. And along with that, in certain cases, if it's routed through an institutional setup, you might want to look at FDI limits or any of the other RBI limits that are imposed on certain sections or certain sectors. For example, now the insurance limits is away, or the retail limit is away. But if it would have been an investment in telecom or any of the other defense or any of the other sectors, you might want to look at the FDI limits or any of the limits that has been sanctioned by RBI or any of the prevailing government entities as such. But more so, overall, broadly, it's just looking at whether the legal compliances have been taken care of from an RBI perspective. Your FCTRS or FCGPR, whether it's a primary or a secondary scale, have been taken care of, and the funds have been parked in an escrow account and not used till the entire transaction is over. Broadly, these things need to be taken care of. But more importantly, it also needs to be taken care of that, let's say, whenever the external party or the overseas friends and family entity needs to exit, if they're partially exiting, there would be further compliance of FCTRS and RBI compliance as such. So make sure that you have an understanding with them that the exit would not be immediate. The exit would be when there is an institutional round that comes in, and the exit does not have to be partially there, though it can be, but for the sake of compliance, you follow for that, and there's no clutter or chaos later on when there's
Yes.
an exit opportunity that presents itself.
Thank you, Ojasvi, but we have more queries coming in, so we will continue this Q&A session next week.